Good afternoon, everybody. It is Monday night, April 10th. Quick go through some stocks and options of the week. And I am in the middle of a thunderstorm by me. The power has gone out once, so this is the second take. If it goes out again, I will simply wait for the power to come back, record at my leisure, and put it on the YouTube channel. So we're going to start with option ideas. As you know, I put up the covered call ideas, secured puts, some ideas about when to sell. Has to do with oversold and overbought. Watch list from Stock Rover, which I'm adding now. Click on it, you'll get a download. You'll get all the stocks, and very easy for you to rank by column. So relative strength index is column I. There you go. So relative strength index, very nice. So what we see is that some of the stocks that are oversold, and what I will often do is I will just do some conditional formatting here. And I don't know, there's a way to make that column stay in place. I have to figure it out every time because I don't really use this as much as I should. Protection, I don't know, whatever. There's something up here that makes it just stay in place. View, might be view. Ooh, freeze frames, oh yeah. Freeze top row, blammo, look at that. Look at that. All right, so you can play with that chart any way you want. And when you sort it by relative strength index, pretty easy way to see what is overbought and oversold on the daily basis. What's oversold right now or close to oversold? Very few stocks. So we have a couple that we're going to take a look at today, including Intel, AbbVie, Acadia, Exact Sciences, and Lumina. Acadia is new on the list. I'm going to take a look at Teladoc as well. So these are the four that I think if I was looking to open positions, looking to generate some put premium, I'd go with AbbVie, Intel, Acadia, Pharma, and Zendesk if it fits in with your particular strategy. AbbVie, obviously, dividend payer, healthcare. Intel, semiconductors just got beat up. Acadia Pharmaceutical has a novel drug for Parkinson's and several other applications that they're close to the end of trials with. I might have got them mixed up with the other company I was looking at. I was looking at Alexion as well. And then Zendesk. So if we just quick whip out these charts, they all switched to one company. Oh, okay, ABV. So the power outage got me. All right, so I just updated this chart for you. There we go. So here's AbbVie. And the thing that I would encourage you to do is look at the longer time frames. And you have your 0.5 here, your 0.618, and then an extension level, kind of a complete retrace would be occurring here. So I think AbbVie is close, not quite, into the buy zone. And if you really liked AbbVie on the dips, I kind of like how this is shaping up here. You got a bottom, similar bottom, but a little higher. I think you might be able to get this right at the 618 level. So if you're going to sell a put, I might probably sell the 85 to October. You'll get $4 or $5 per share for that if you finesse it a little bit. That doesn't mean just run out and sell that put right now. It means find a spot this week where you have the technicals on your side. And it might even take until next week. So don't be click happy. Do your analysis, get used to the stock, see how it moves, and understand that heading down to this 618 line is not improbable. Why do I sell the 85? Because that's towards the end of the top of the buy zone. And if I can get about $5 for an 85, that gets me way down to the 618, right? An average cost of 80, which is about where I want to be. And you know, we could even, if you are just a bottom fisher and you want a cost closer to 65, 70, then maybe you sell the $75 put and wait until you can get $5 for it. So when you're selling puts, always think of, okay, where am I trying to get it assigned to me? Because if you're selling puts, you are trying to get it assigned to you. So how much do I want it assigned to me? And how much premium do I want? If I sell it at a higher price, I'll get more premium. I sell it at a lower price, I'll get less premium, but it'll be less likely to be assigned to me. So if you already have AbbVie, and you're like, I'm just trying to augment the income that I get from that, you know, then probably sell the lower strike prices, you know, close to, you know, price of 70, you know, because the, let's see if I can move this over to make it a little easier to read. There you go. So 65 is that level down there, and then 50 down here. I mean, I'd be hard pressed to see AbbVie down at 50. That probably should be the bottom fishing price, but I think it's unlikely to go under this level. Structurally, you see, right? It fights in this area, comes back, fights in this area, comes back, fights it, can't quite get through, and then breaks out. Comes back down, and what once was resistance is support. Is support again. So I don't think it breaks through here again. So somewhere between here and here, you know, set your price and say, okay, the most I want my net cost to be is about 80. So if I sell the 85 put, I'm looking for $5 in premium. Easy enough to understand? All right, so let's move on to the next one. Oh, I just killed my page. Reopen. These browsers are so much better than they used to be. Let's go on to Intel. Intel, of course, just talked about farming out some of their production. The market wasn't very impressed with that. And it's way down. And you see this trend here, that's pretty good support. I mean, every time it came down into this area, you know, it couldn't really break through. So I really think that you could take a higher price on Intel. But I think really the bottom here, you know, is likely to be the top of our buy zone. If there's a big correction, could it go lower? For sure. See this structural area here? All this fighting in this area? That's an area it could get to and fight again. So let's suppose you want to open a position in Intel because you like the dividend and you like the long-term growth, and you say, okay, well, look, they've got all the money in the world, so they're going to fix whatever problems they have. They're streamlining operations, which is a shock to the confidence. But if I could get this for a net cost of, say, 40 or 35, I'd be really happy. So if you're looking for a net cost of, say, about $40 a share, this would be the top, right? Got to there, came back, got to there, came back, got to there, came back, got there, and broke out, right? So let's say 40-ish is a pretty good floor. It's at a fib level. It's a spot where where it was resistance, turn the resistance into support. Now, that doesn't mean it can't go through the support further down. I think it could go further down. I'd have a hard time seeing it under 34, so that's what I set. But I think the most likely occurrence is that it probably doesn't get much lower than where it is. And if it does, you're looking 40-ish, and then some retracement and some consolidation before it comes back up. And if we take a look at this a little bit longer, you see that Intel clearly has a setup to shoot up to the 80s. Now, I don't think it's the type of setup people have come to be used to in the last 4 months where, hey, everything should double in 4 months. No, maybe in 4 years, right? So if you can get Intel chopping around here or a little bit lower, I think that's not a bad idea. I suggested the $45 or $50 put for November, which is just for October, which is just ahead of the November ex-dividend date. And that's just something I like to point out. If you're going to sell puts, sell your puts to expire just before the ex-dividend date. That way, if it's put to you, you get a dividend right away. So AbbVie, I'm selling the September 85s, trying to get a certain premium that would get me a price that I'd be happy, and that price I'd be happy with ahead of the October ex-dividend. And from a macro standpoint, we're thinking maybe there's a correction. So you don't have to be real aggressive here. You can take a look. You take a look at the option chain for AbbVie over at NASDAQ is a cheap way to do it. You say it's September. I want just the regular monthlies. So third Friday is a regular monthly. You say, okay, if I'm going to sell the 85, right now I can't get much money for it. We were hoping to get a net cost around, 80. So what I would do is I would set a limit order to get the $85 put for $5. And inevitably 4 people are going to say, but it's not anywhere close to $5 right now. Stocks are volatile, folks. Stocks are volatile. Stock moves $5, this is going to go up to $5, right? If it goes down $5. So when we look at the AbbVie chart, see, look, yeah, it could pretty easily drop $5. And then I want to, start working on that. So I'm giving you a little bit of lead time to work with this for a week or two. Same thing with Intel. We take a look at the options. You say Intel, boo, 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 boo. Give me the option chain to October. And I want just the standard monthly, which is all the offer there. And they're not giving me a real wide range. There's a way to change that. But see the 45, if I wanted my net cost to be 40 on Intel, I'd say, okay, set a limit order for $5 here, and it'll hit while I'm out fishing or playing in the yard or whatever it is I'm doing. Okay. So Acadia Pharmaceutical. I just want to take a quick look at Acadia so you guys understand who they are. There is a couple of good articles. This kid wrote a good article. This guy, okay? This guy is doing a good job covering the company. Read his articles. It'll get you pretty good idea what's going on here. I've never had much use for Brett's analysis. I just think he covers too much stuff, and I you know how I feel about certain people who cover lots and lots of stuff and write lots and lots of pieces. I'm just throwing out notes at this point with some quick thoughts. So my next article is, which I'll finish tonight, quick thoughts on stocks of the week, which is going to be the weekly Monday nighter, hopefully Monday afternoons. Got some MGM resorts in there, some other things, and we'll come back to that. But read up on this. I think Acadia has been one of these companies that I think we overlooked because it's hard to understand, but really it's pretty simple. They have a drug, right, that has multiple ramps. He gives a real nice chart that I think is about right as to what the range is on their returns. But really, here's what the market is missing. Here's what the market isn't pricing in. And what do we talk about over and over again is there something that the market isn't pricing in? And I don't know if it's in this article of his, but I was taking a look at their presentation, and they have like 4 different applications for this drug. So they could increase their sales by literally 4, 5, 6, 7, 800% over the next several years, into the late part of the decade. And if they do, stock probably take off. So you take a look at Acadia, and if you are looking for something that's got explosive growth, this is the first wave, came back down. I didn't really care about all this. I just care about more recently because the company is kind of developing a new MO. I think if you can get this stock anywhere in the 30s, you're probably doing all right. And we can rebuild this chart pretty easily if we want to. If we want to go all the way back here, this is really the birth of the company right there. The new birth of the company right there. This is when they got their approvals, or when people thought they were about to get their approvals, and then they did. Just build your little chart here. Let's say right here, right there. You turn that one pink because that's what we do for the longest one. You say, okay, where are we now? So the original retrace and extension. I said, okay, that's pretty interesting. So the 0.5 and the 0.6 are right down there. Could it get that low? Sure could. We want to take the newer stuff. Say, okay, here's a new pivot low to a new pivot high. Make that blue because that's what we do. And we're looking for structure in the chart. So where is the structure in the chart? It coincides with these fib levels. That's pretty interesting that it hit right down here at that fib level, right? We used to say it over and over again. It's interesting that it happens. And what those fib levels help us do is identify where the real big support is. So clearly, there's some pretty big support down in here, which makes me very willing to buy it. So this one right there, ones are always pretty powerful. So if we're looking at a more intermediate term time frame, guess it could get down to, a little under 20. But also you take a look over here and you say, well, where's it extending? And that's a heck of an extension, right? A heck of an extension. Comes back, comes down, and now it's down. And the question is it about to zoom up, or do we have a little bit more petering out into this area? You look for a 618 or a 1 or a 0.5, some of the more important numbers. You go, huh, I like that spot right there. And I say, okay, if it doesn't get this low, I don't need to own it, right? I don't get enough for my money. But look at that. Got to there and it's stock going down, right? So with their revenues, it gets down to about 35, right? I think you're doing pretty good for yourself. Could it get a little lower? Could. And remember, we gotta watch your other numbers, right? You have to take a look at your MFI. So if it gets down to 35, that's probably pulling MFI down in here, right? It's probably a buy. Relative strength index, right? It's heading down at about $35 a share, somewhere in the 30s. It's going to be down here again. It might not even get down here, but in that area. So keep an eye on those technical indicators. You have your MACD, which is basically saying down for a while, right? So that's why I'm telling you about it now, because it looks like it might be down in the next couple of weeks. And you could sell puts. You could do whatever you wanted, depending on how much you wanted to own this. I suggested December 35 or 40 good till cancels, right? And again, I think that at 35 net cost, you're probably doing pretty good. So maybe you set a $40 put at $5 for premium, or maybe you sell a $35 put for like $3. You know, you got to finesse it, see what everything is saying at the time. But I think this is one you can keep an eye on, because if you can buy it here, or maybe even get a net cost in here, this to me looks like it's ready to zoom back up, you know, get way up here, set new highs in the next couple of years. Last one, Zendesk. Got a lot of GLDD charts. So take a look at Zendesk. Get your sound effects in there. I was just playing with the baby. All right, so Zendesk, take a look at this area here. Bouncing around, right? Or last couple of years have been bouncing around. I don't think I'd want to buy the top end of this range here. In fact, I'm going to push this all the way down to there. Why there? Well, it's right above a zero line. This retracement, excuse me, that's an extension. Hard to read right there, but it's a 0.5 extension. I think what I really want to see, though, is I really want to see right at the zero line, which happens to be a 618 extension on the other side, and a 0.5 there. This area here where it didn't break through, came back, broke out. It violated a couple times. You know, you could see this come all the way down here in the worst case scenario. You'd have to see the world change for just, you'd have to see an undoing of a lot of things that just happened. So I think the floor on Zendesk is a lot higher than it was. I think really it's valued up in this range somewhere. I can't imagine it getting under 60, but it could for a hot minute like it did here for a second. But I think buying it in this yellow box is interesting, because next time it chops, it could come roaring out of here. Why could it come roaring out of here? Because the work from home environment's not going to change. I'll tell you, I just took a trip in Wisconsin along our shoreline from Milwaukee all the way up to Two Rivers. And I have some pictures that I'm going to download from my phone and put it into the Quick Thoughts article. I'll tell you what. In some of the small cities, Port Washington and Manitowoc and Two Rivers, these are 30, 40, 50,000 person cities. There is a lot, they got really nice main streets. And the reason they have nice main streets is because that part of Wisconsin used to be pretty heavy in shipping, manufacturing, and wood and paper. So there's a lot of wealth in there. In fact, it's like the fourth wealthiest region in America with the most millionaires per capita. So if you didn't know that, that whole Fox River Valley up to Green Bay down to the North Shore of Milwaukee, there's like a triangle, and it's got, you know, and I'm sure somebody cut it out specifically to be that area. But it's, you know, one of those manipulated pieces of the map where you look at it and say, wow, there's an awful lot of millionaires per capita here. And it's because there's a lot of wealth that was passed down over the last century. John Astor was the richest guy in America for a little while, trading beaver pelts out of that area. You know, this is a couple hundred years ago. there's a lot of money up there. And what I will tell you is that they're redeveloping some of these towns and cities. And I'm going to look into the legal aspects of this. But I'm thinking about starting a limited partnership to buy some of the real estate. I actually found real estate on Lake Michigan or with a Lake Michigan view that was cheap, which doesn't make any sense to me. So I'm thinking of investing my money into properties with a view of Lake Michigan that are far enough off the shoreline that we don't have to worry about the mitigation ourselves. And it is becoming apparent that the government is going to take care of a lot of that anyway. Which brings me to one of the other companies that I'm going to talk about this week, Great Lakes Dredge and Dock Corporation. This is one of the companies on the rebound list, and they've just been chopping along because they're just your general profitable company. They don't pay a dividend just yet, but their debt has been coming down and down and down. And I don't know if I have. I have to pull it up here. It disappeared when my power went out. I'll just show you this research report. There's a chart in here that I think you're going to find interesting. Debt to equity. How's that for 2 years? Cut their debt basically in half. So they led the S&P 500 and were beating the industrials for a while, and now they've come back. I think you're going to see it outperform again in a not too distant future. This is a stock that I would think under a Biden presidency with lots and lots of money allocated to shoreline preservation and restoration, these guys could double, triple their revenue. And remember we talked about Kinder Morgan, how all their new deals, basically the people who wanted them to, transport gas have to pay for the pipeline ahead of time. That is what's basically going on here. So if they need new ships, the contractors are basically going to, the people who want the contract work done are going to have to pay for it. So they're not going to have to borrow to build new ships. They're just going to get a contract. The contract's going to be like, hey, we need you to do this. And companies going to say, well, we need a ship. And they're going to buy a ship, maybe from Manitowoc Corp. Who knows? I don't know where they buy their ships. And then they're going to go out. And these guys are the biggest in the country at what they do, at protecting shorelines. So they're all up and down the East Coast and the Great Lakes region. And I expect that this company is going to at least double in size and probably triple or quadruple in size over the next decade. I mean, really, just based on the numbers, right? It's a $638 million company. This is a company that could be worth, $5-10 billion by the end of the decade. So, they are an asset-heavy company, but if somebody else pays for the assets, right, now suddenly you're an asset-light business model, and that's what they're doing. So I like Great Lakes Dredge and Dock. I'm not sure I love them quite yet. I would love them if they started paying a dividend, and I think there's a chance that they could pay a dividend eventually. Right now they're not. So we'll see. They've got cash on hand. Altman Z is high enough. It's over. It needs to be a little higher. I mean, they're one of these companies that's getting better and better and better. So I think we might be getting them at a pretty good price. So they came down off their recent high, started to rebound. I think if they get back into this area, 8-ish, I think I'll probably buy a little bit, right? And, I didn't really know much about these guys back here. They weren't a priority. But take a look at this rally. From 3 to 11. I mean, would it break your heart to triple your money? Given that I think this company is going to get bigger and bigger and bigger, and they're going to be able to maintain a good margin, and it's all going to drop to the bottom line. So I think that these guys just add more and more and more dollars is what I think happens to them. So some of the other companies I want to talk about. So I would like to talk about MGM. MGM just got a new investment from IAC Corp. And I want you to ask about that. You know, MGM is on the rebound portfolio. I think, and Caesars is too. The question I brought up the other week, or it might have been Friday, is if they don't go bankrupt, at what point do we want to buy them? And IAC just gave them $1 billion. They took their position in stock so they could finish their Japan casino. And as a guy who understands this particular industry really well, I think the MGM of the two bigger chains, there's just so much nicer than the Caesars properties. Caesars has the World Series of Poker brand, which is a big deal. But I think that becomes a bigger deal as it goes online. So what is the thing that the market is missing? Right now, the market is not valuing any internet gaming for these companies. And now that there's a couple states that have internet gaming, I think you need to ask yourself, well, at what point does the whole country go that direction? At what point does the federal law change and say, look, we're going to allow online gambling, but remember, everybody's got a lobbyist, but you have to be a partner of or actually be a U.S. regulated casino. There's the rub. So when Las Vegas Sands, which has been opposed to online gambling in America, when the patriarch finally dies, I think he's actually changing his mind already. You're going to see companies like MGM and Caesars, Las Vegas Sands, and Wynn, and I'm sure there'll be some Indian casinos unless they can get written out somehow for not technically being on sovereign land, but on U.S. property. We'll see how they write the law, but I think you're going to have to be under a U.S. gaming commission to be able to host online gaming in the United States, and that'll be really good for these companies. Intel, we talked about already. Twitter, going to talk about TikTok, but in general, we've liked Twitter in general because of just their ability to connect people, and I think that Twitter has the ability to compete with Facebook. How would they do that? And Instagram, right? They already have a platform, and I think that they could create it, and they can make it more personal if they wanted to by running parallel platforms the way that Facebook does. Facebook bought Instagram and runs that in parallel. I think Twitter can do the same thing. I think they're already getting into entertainment. I think Periscope can be utilized better. But Twitter is an execution story. There's nothing automatic about it. So you have got to know Twitter well to want to invest in it. But on these pullbacks, because it's been chopping. On these pullbacks, I think you buy Twitter around $30 a share. And you could sell cash secured puts, say $30 a share, every time that you can get like $3 for it, right? They don't pay a dividend, so you don't have to, walk it around there. But here it broke through support, had a hard time getting up, and then broke through. So this line right here, right? This 618 line, right? Another freaking 618 line, right? It came through it, but it came right back. I think Twitter, $25 to $30 a share is an awfully good buy. And I don't think they're going to get regulated. And if Facebook has to spin off Instagram, which is what I think is going to happen, Twitter all of a sudden can get into a lot more spots and become a competitor, which is what the government wants. The government wants competition for Facebook, Google, Apple, Microsoft. I think Twitter can be that competition. think of AMD and Intel, right? AMD was just a little pain in their butt, and now all of a sudden AMD is a big deal. I think Twitter can become a big deal. So I think getting it around 30 is probably what you want to try to do, and you can sell puts to do it. And because it's tech, you're going to get a lot of money for the puts. So if we just flip on over here, I got rid of my option chains. Option chain. And all your brokerages have this. I'm just doing this here. If we're anticipating a correction in the fall, and we're not quite sure how bad it's going to get, we'd like to have a net cost of about 30. Maybe we set the $35 put, and we ask for $5, right? So you need Twitter to drop a few more dollars to get 5 for the put, but that's only a few dollars of volatility. So that's how you do that over the next few weeks. And really, I think, into October. So you might end up bumping this out to December and say, okay, look at this. Maybe I can get $10 for this one, or $7, which would be 20%. You'd be happy making 20% between now and December, have a net cost on Twitter of 28. I think that's about right, but you set it maybe a little bit higher. And the reason you set this higher than the price you think it's going to get to, if you think Twitter is going to get to 30-ish, maybe you set the 35 at $10. Now all of a sudden you're a net cost of 25, but because the strike price is up here, you're pretty sure to get it. And if it shoots back up in a V shape, you just keep the $10. Break your heart. Invesco decision time is what I talk about up here in the bullet points. Invesco is closing in on decision time. Over the next month or two, if Invesco starts firing people like I think they're going to, because they don't need half of their mutual fund staff, then I think that you are going to get a heck of a deal on Invesco, right? Because I think they'll fire people way before all right, we're going to do that or rewrite this. I think they will fire people way before they cut their dividend. Okay, so let's take a look at that. Get rid of some of these newer ones. Let's just take a look at the big picture. So all this volatility that's occurred, this looks a lot cleaner now when you smooth it out, right? And you go, oh, look at all the chopping, but look at that. It's a pretty clear shape, isn't it? So now all of a sudden you've got all the way down here. We can make this one chart. And you start going, huh, look at that. Or you call this the pivot, then maybe this is a pivot too. But I don't think so. I think the company needed to come all the way down here. So in hindsight, you go, okay, how do I fix this chart to reflect what really happened? You go, okay, well, that's where it got to. And now you start taking a look at that and go, okay, where could this go? Well, it's pretty clear that this area in here was a buy. The question is it a buy all the way up to here? I don't know. I would like to make the money from here to here, right? I'd like to make that 60, 70%. And if it runs all the way back up here, this area here, see where it fought, came down, fought it, came down, fought it, finally broke out. This move up here probably was wrong. It didn't discount the change in the market. And remember, Invesco has gone through like two reincarnations already by buying Oppenheimer and buying other stuff. So I think if you look at the more recent, take this low to here. Weird that that was right at what level was that? So that was the 1 level for the extension on the bigger chart. And if we take this extension from here all the way back down, so we're going, look at all these little levels it can go through. Then this one right here, that's where it's going to fight, right? Because it fell. That's where it fell. But this is the gap to fill. So I think you're buying the dips on Invesco here. I think it's going to fill that gap. Now, does it break out after that? We'll see. If they fire a whole bunch of people, it's going to break out. So I think Invesco, with this big fat dividend, you need to be buying this around 10, or 9, or selling puts. But the thing is, the puts, you don't want to sell it past the X dividend date because you want that dividend. So you'd want to finesse this and say, okay, when is the X dividend for Invesco? I'll add Invesco there. X dividend date for Invesco is 9, 10, 11, 13. 1, 2. So you want to write the October puts because the X dividend is before the option. So October puts on Invesco. Not sure why it's doing that. I must be putting it in the wrong box. October 10s, 12s, I don't know. Take a look at the chart again. Say, well, 11, 12, 14. A 12 or a 14, I think, if you really want to own this. Let's say 12, right? Sell the 12 to make sure that you're going to get it. You're going to get a lot of premium if you sell the 12. There isn't a 12 that's showing here. I don't remember how to do the settings on here. But, if you get $3 for a 12, October $12 for $3, net cost of 9, and it's probably going to get put to you if there's a correction, and then you get the dividend, and then they're firing people, so it's going to take off, and then we're going to get trillions of dollars of stimulus next year. I like Invesco down in this area. So I think the pain in Invesco is probably over. The catch with Invesco, and I'm going to add them to the Quick Thoughts article. The catch, I think, with Invesco is if they don't fire a bunch of people after Labor Day, then maybe they'll cut their dividend instead. But I think they're going to cut a lot of people. I think they're going to do the same thing all these other companies are trying to do and reduce headcount. Tech their way up. One of the things you should know about Invesco is they really have revamped their customer service and sales to be more and more online and dialed directly into the brokerages and the advisors. So, and clearly QQQ is a favorite product. So I think Invesco you should be pretty much on top of. All right, let's call it a day here because that was a good time. Yes, Acadia was on a list a couple of years ago. I got rid of it. I didn't look at it again until last several weeks. But I think that they're probably going to come back into this region here. I don't think they get to the bottom part, but I think in here they get to. And then I think it's back off because in the next year, they're going to have more approvals and more business. It's just, I don't think the market is appreciating that they're going to probably bounce. And it's because it's not a COVID stock, right? It's not a COVID stock. So if you can get this back in the buy zone, I think it becomes a pretty interesting play. Look at what their technology is and look what they're doing and look what they got coming. It doesn't take really much to move the needle on this company at this point. So I think that you could see a pretty good bounce. There's about a dozen biotechs that are starting to come back to us. So we really need, I think, in the next 3-4 months to evaluate these biotechs and figure out, do we just want to buy ARC Genomic Fund or do we want to build our own basket, right? I'll be honest with you, I'm probably going to buy the ARC Genomic Fund because this is a lot to keep up with, right? But I'll probably also invest in like my 5 favorites. So it'll be the ARC Genomic Fund plus 5 of them that I think I can keep up with. A friend of mine has been on me to take a look at this stock. They're on the list. I mean, they're on our list. But Natera has gone nuts. And he was buying it down in here, and I didn't listen. And there you go. So he was buying it under 12, and now it's 50. I don't know. What is the smart right? Because we have to figure out what time frame is right. I don't know what time frame is right for these guys. These companies, their business models change. So I don't know if this was hype and then pullback, and this is a slope of enlightenment, or if this is just something they tried and failed. I don't know. I have to really investigate whether or not the company and the first peak is the same, right? If their business model changed much. But if you take a look at just the chart, you got some pretty nice pivots, right? And that's pretty easy to see. So if you go to here, it was already breaking down well ahead of COVID. So, you know, a lot of times with these charts, you have to interpret, you know, what's reality and what was just a hot minute. Came back down to here, right on a 618. Look at that, 618. Came down to a 618. And you take a look at this chart and you go, okay, where can this go? Well, it's got a lot of breakout. I mean, it goes through here, through this 53 range. I mean, it can just shoot towards 70 very quickly. So if you think the market's going to get bullish again, this is a spike that could happen. So having a couple calls on this one, even though it's hitting this resistance line, is interesting. But that zero right here, that zero right there, the fact that it stopped going down here at a 618 line, you know, I think that 1.618, that 618, I don't think it's going to go below there. This is a stock you should get to know. A couple of novel things they have. Middle 40s. If it's really as strong as it seems, it'll consolidate up in here and then take off for another leg. If the market goes south and takes everything with it, come back down to this bottom range. So that's what we don't know. We don't know if the market's going to go south. I think it is, but we don't know. So I'm trying to give you both approaches, and you can decide how aggressive you want to be. Do you want to get super aggressive, or do you want to say, look, I just think this becomes a value down here, and if it gets there, I'll buy it, right? Me, I'm probably more likely to say, well, if it gets down here, I'll buy it. I'm probably not too likely to buy calls up in here unless this happens really late in the year and Biden's already won, right? Again, just to clarify my take, I think that if we get more trickle-down economics and tax cuts for the wealthy, if Trump wins, and more destruction of the dollar, we're setting up for a crisis. If Biden wins and he governs from the middle, I think we see some improvement. But if he governs from the left and he really does a huge infrastructure bill and he makes the tax code more progressive by making capital gains same as income tax, which is what he said he's going to do, now all of a sudden you have a federal budget that brings in more revenue and there's a lot of stimulus and the dollar stays firm. To me, that's the Goldilocks scenario. So if we can bring in more revenue from the top 1% and everybody else pays the same and make healthcare a little bit better and put out some of these forest fires with our allies, we're going to have to keep the pressure on China. But the supply chains moving back to the United States, the stimulus, and a dollar that doesn't get beat to hell, man, I think all of a sudden you've got a pretty good recipe for a boom that's really rolling by a year after the vaccine. And again, that's another what-if situation. So you really have to decide to what degree you think there's a vaccine, how much you want to invest with the uncertainty of the election. Like I said, I think that Biden's going to win going away, but, maybe I'm wrong. I've never gotten one of these wrong before, right? I picked Trump to win. Wasn't happy about it, but it was clear to me that he had a lot going for him in the Midwest, which I don't think he has going for him anymore. So to me, I'm trying to pivot towards a Biden presidency. And if it ends up being a Trump presidency, I'm glad that I'm market neutral. So, things will become more and more apparent as we go. We should know tonight, if it hasn't happened already, or tomorrow or the day after, should know this week on who the VP pick is. And I'm hearing it's not what you think it is. So I don't think it's Kamala Harris. I think she's going to be the AG. I think you're looking at Michelle Obama if she's willing to do it, which is what I think Biden wants. I think he's been trying to convince her, but I think that Bass and Demings are the two dark horses that I would bet on. Kamala Harris is the easy bet, but I just don't think it's her. I don't think they need somebody out of California. I think they'd much rather have somebody out of Florida, or at least Bass, who's also out of California, is Black Congress. I forget what the Black Coalition or whatever it's called. I think that's probably the ticket there. In any case, this company, you should take a look into it because they broke out. They broke out over this level, and if they don't come back down below about 40, then there's probably another big leg up. And that might be something that becomes a swing for the fences stock. All right, call it a day.